Yeah, and you could argue in some ways that actually insurance as an industry on the equity side is actually doubly linked to the economy in some ways, so even more so because, as we talked about with Harold on the corporate strategy episode, a lot of insurers effectively use insurance premiums, so the policies paid for by their customers, to create a float of a big fund, basically, or a big pool of premium that can be then used as a vehicle for investment. So it's with this big pool of premium, they are able to invest in a variety of things which probably will be quite strongly correlated to the economy. However, actually, this is quite an interesting piece because most insurance companies want to be very sure that they're able to pay out claims, so they tend not to have very large proportions of their investment portfolio in riskier assets. So you won't see many insurance companies with huge stock portfolios. They tend to focus more on very predictable things like government bonds, where often the yields on those bonds are fixed and known, so they know exactly how much they're going to earn from holding those bonds, and they don't have to worry about the risk of default as much, unless of course the government's collapse, which is a very difficult scenario. But they'll tend to have a much safer portfolio of assets, which again, for the very advanced listeners out there, you'll probably be familiar with what then starts to happen with bond prices depending on interest rates, because if those yields are greater than the yields from interest rates versus or not, that can also have quite an impact on how the bonds that you hold are priced and so on, which again can affect your interest, so your investment return as an insurer, which might be there to prop up that non-correlating part of the insurer's book, which is, did the claims happen or not?
Yeah.
Unless, of course, those claims were affected by inflation and by fraud and all these other factors.
Well,